Hi everybody, it's great to be here today presenting in this Asian Base Oils virtual conference. My name's Michael Connolly. I'm a senior consultant from ICIS in our analytics division, focusing on base oils. So today I'm going to speak to you on some Asian base oil market developments in 2020. In particular, I'm going to talk about the demand impacts of COVID-19, the effect of crude price movements this year, and look at some forward demand scenarios. So if I look at a detailed agenda of what we're going to talk about today, I'm going to start off with a brief introduction, just highlighting some general issues in the marketplace at the moment. Then I'm going to dive into a more detailed analysis of the first half of 2020. So I'm going to look at demand and prices in a number of regions with a focus on Asia and some key countries within Asia. Then I'm going to look at the changing trade flows between 2019 and 2020. And then I'm going to look at some of the effect on margins for Asian base oil producers. Then I'm going to move into a more forward-looking segment of the presentation. Firstly, I will just briefly describe to you our methodology for how we are reviewing demand scenarios under COVID-19. And then I'm going to take you briefly through the demand that we have estimated for Asia in 2020 and take a brief look at beyond. And then finally I'll just wrap it up with some conclusions. So what an interesting year 2020 has been. We have had a lot of change in all of our lives. Like many of you, I'm doing this presentation from home today, presenting to you all. Many of you will be sitting in your offices or at home right now. But the level of turbulence for base oils producers has been just as high as for everybody else, if not higher. So there was, at the start of the year, a very rapid and sizable movement in the crude price as Saudi Arabia and OPEC changed its supply position, flooding the market with lots of crude, which really dragged the price down dramatically, even seeing some negative prices at some point in the US. And then very quickly that was followed by COVID-19 expanding from an issue within China and Northeast Asia into a global pandemic, which obviously we're still feeling the effects of right now. This has created huge impacts on demand, not only in base oils, but across the entire petrochemical industry. The other part of this is the uncertainty of the future of demand, as no one knows exactly when COVID-19 will come under control, and this creates huge challenges in forward planning. So understanding how and what we expect in the near future and the assumptions under that is going to be important for all players in the market. So if I start by looking at an analysis of the first half of 2020, I just want to start with some overview of context on different regions. So if we look at demand across the globe, we can see that Asia is one of the major players in terms of demand. It's the biggest demand region, particularly when we aggregate Northeast Asia and Southeast Asia. Then followed by North America and Europe and the FSU, which each are about a similar size. And then we have the Middle East and Africa lower down. So in the context of looking at demand, I'm going to very briefly cover North America and Europe before diving a little deeper into Asia. So if we start with Europe, when we look at the data that's available, we don't get short-term data in a sufficient number of locations or countries to see what the actual demand has been during the first half of 2020 or even to the third quarter of 2020. And so we use a proxy here in terms of understanding how we think the market might have behaved. So if I look at EU road fuels demand as a proxy, you can see on this chart the green band is the traditional, is the range between 2015 and 2019. So all the values between 2015 and 19 fell in these ranges. And you can see on the blue line there that the performance in 2020 obviously suffered a severe drop. and you can see it was as much as 45% reduction in Europe. So, this we can use as somewhat of a basis for estimating the effect that we might have seen. And what you can see in the base oils prices is it does track that reduction in demand quite well. So you can see we were going along relatively stably, even into March, where we started to dip, but we didn't quite fully reach that. But then as we really dropped off into April, May, the prices also dropped off into April, May. And then as we recovered in June, we started to see a bit of a recovery through the various grades in the European market. And that really matches up with when lockdowns were most severe. And now we've seen a bit of a bounce back. If I look at North America, we see somewhat of a similar trend. You will note that there's probably a wider range in the upper graph. So I've also added here the average demand over that period, and you can see there has been 1 or 2 years where the demand has been very low like this. But usually that's resulted in a bounce back in demand in the second quarter. But that bounce back wasn't seen in the US this year. So you can see how that demand has really dropped off, and that led to a drop off in prices in the US. But that demand has been recovering with the latest available data up to June. But you can see via the prices that there's been a slow and gradual recovery of the prices into the base oils market in the US. What you can see is there's a more limited recovery in the Group 1 and Group 2 markets, where the US is very long, as it's one of the major global exporters in both of those products. Hence, we're seeing a slower recovery in price on those markets. Even though domestic demand is picking up, there's still suppression of global demand from previous historic levels. So that gives us an overview of Europe and North America, just in the sort of most key demand countries outside of Asia regions. But now I'll dig into a few of the countries within Asia itself to have a look at how that might have affected demand within Asia. So again, within China, we don't specifically have a lubricant figure, or base oil, I should say base oil figure, that we can pick up on a regular basis. So again, I'm using road fuels, so road diesel and gasoline as a proxy. And what you can see, as we're all aware, that the pandemic started first in China. So it saw those heavy lockdowns and restrictions within the country around the January and February, March period. And so you can see that corresponds to where the demand for fuels was much lower than a historic range. But we have seen a recovery of that, and even according to the latest figures out of China, that they're above historic figures, effectively catching up a little bit in the market. But we'll see how that plays out throughout the year and how that recovery continues. But certainly, this complies with some of the information we're hearing out of China that they've recovered relatively strongly. But we will wait and see on the global effect of that and whether that can be sustained. You'll see that the prices in Asia don't match that specifically. These are the general Asian prices that you'll see for all of your subscribers to the Asian Base Oils report, as opposed to specifically the Chinese prices, because we're taking a more broader focus here. And you'll see that downturn came a little bit later in Asia as more countries within Asia started to be locked down. If I move on to South Korea, we have the South Korean lubricant demand that we see. And again, here's an interesting note. South Korea was one of the countries that was less impacted than many countries, particularly early on. It had a good suppression of the cases, which resulted in a quicker stopping of the pandemic within the country. And so you can see from this chart in terms of lubricant demand, yes, while we did dip under in March, we've sort of maintained within or close to historic ranges of demand within the country. What you can see is that, we're now starting to see another little dip again, or we were starting to see another little dip again in the available data in up to June. Just as we see recurring waves of impact within society and again further lockdowns. Not as severe as the initial lockdowns or measures that were taken, but still enough to impact demand. But importantly, also for South Korea, local demand is only a medium percentage of production, as it's also a very large exporter. So roughly half of the production within South Korea is consumed there, the rest being exported. Next, we take a look at Japan, and it's somewhat similar story to South Korea, where again there was a good suppression of cases. The effect on the industry and demand was limited, or more limited because of that early catching of the cases and limitation of the spread. But again, we're seeing second waves and further waves coming through Japan, and you can see it's running at very low levels compared to history, but not off the charts like we saw in North America and within Europe itself. So again, that's feeding into sustaining a bit of support within the market. And finally, we have India, which is an interesting case. So India saw a very, very sharp drop, a very, very sharp lockdown put into place that came within days of announcement. A very high level of disruption within the country. Yet in the figures published by the PPAC in India, we don't see that huge drop in lubricant demand. Certainly we see a reduction to minimal levels based on history, but we don't see that huge drop like we did in other parts of the world. Now, these numbers reflect some key countries within Europe, within Asia, but what you see is that the effect that is coming through really is in different times, is in different waves. Hence, it's moving through Asia in a more gradual sense as it affects different countries at different rates, and it's a large geographic region, as opposed to the type of effect that we've seen in Europe, where it's been fairly rapid, everybody suffering at once. And to a similar extent, North America, even though regionally there is differences in North America, we've seen a fairly quick response. So this is flowing through into slightly less, while there is a drop in pricing, it's been smoothed a little bit, and the pricing is relatively stable with a little bit of recovery in some of the grades coming up to August as slowly those demand is returning into the various markets as each of them peaks and troughs at different times. If I turn our attention now to trade, when we look at the trade we track globally on a monthly basis, if we compare the first half of 2020 to the first half of 2019, we see there's only 84% of the trade that we saw in 2019, so a 16% reduction in trade globally. Now, the majority of that effect came in the second quarter, so it was around 90% of the 2019 trade levels in the first quarter, but only around 80% of the 2019 trade levels in the second quarter. So that really matched with the charts you see earlier, where the North American markets and the European markets really suffered through that second quarter, and then are starting to see a bit of recovery late in the second quarter, and then recovery into the third quarter. If we look at the various trade routes and some of the key trading regions in terms of interregional trade, what we see is that while the trade between Northeast Asia and Southeast Asia still remained relatively high, it's a relatively short route in terms of the global context. We did notice that the Middle East market seemed to suffer the most in terms of exports. So the Middle East exports for the first half were only about 75%, so much lower than the global average of 85% than the rest of the world. So, they seem to be the market that suffered the most in terms of exporting to various regions. And the other key route that seemed to be affected was Southeast Asia to Europe. So this probably makes a lot of sense in the context of that being a very long route in particular. So that sort of dropped down to only 60% of its value in 2019, in 2020. So quite a dramatic drop. Now, that route in particular, it is one of the larger routes in the world, but certainly not as large as some of the really major routes, US or North America to Europe, Europe to Africa and to Asia. So now I'd like to move on to the base oil relationship to crude pricing. So we've looked at the demand side and how prices have been affected on the demand side. But now let's look on the feedstock side of the base oils plant or of the base oil producer and see how the crude market has affected that. If we look historically, I've got 5 years of data here, looking at the crude price, which is the dotted line on this chart and relates to the right-hand side in dollars per barrel, and then a selection of base oil prices across various groups related to the left-hand side of the barrel, the left-hand side of the chart in dollars per tonne. You can see that while the trends are relatively similar, there's a much greater amount of noise within the crude price. And this comes down to the fact that there's just some different drivers within these markets. So while there are some common drivers within the base oil market and the crude market, road fuels demand, the automotive industry in particular, car production and the use of cars, both have key effects on base oils and crude oil. There's some different demand drivers. Jet, while used in base oils, is not as serious a demand driver as it is for crude oil. Bunkers market, same thing. Part of a small market for base oil, but a much bigger market. Petrochemicals and their impact back into the crude market, again, you don't see that effect into the base oil market. Then throw on that the paper trading of crude oil, which adds hugely to the volatility. You see a lot more significant changes in the crude price than you do within the base oils price. Hence, base oil margins tend to fluctuate quite wildly because there is quite an oversupply of capacity within the base oils market. And so, people tend to run to the demand levels. They're not running at their maximum operating levels. And so this tends to mean that, there's a bit of a disconnect between the price of crude and hence the flow on price of feedstock to the base oils plant, the VGOs and resids for some of the Group 1 gas oils. So we start to see, a big effect on margins. And if we look at that effect, here again, I've got the same timeline for our estimated base oil margins in Asia. We see that in the first half of 2020, or in the first quarter of 2020, as the crude price dramatically dropped due to the changing supply situation on crude, we really reaped a benefit as a base oil producer in that side, because the base oil prices were acting relatively insensitively to that crude price because they were still reacting to base oils demand levels, which before COVID-19 were still reasonable. And so we saw a real bump in the crude margins there. And that was particularly a boon for the Group 1 producers who were suffering at the hands of the effects of IMO and the relative impact that had on the price of VGO, globally and within Asia itself, and the price of fuel oil, which is can often be linked to the price of extract. Eggs are Group 1 plants, so the co-products produced by a Group 1 plant. So that really had a boosting effect on those margins of those Group 1 producers. And then we saw the effects of COVID-19 really kick into the market of the base oil side. And so then we are obviously, as we saw in the charts earlier, we saw the base oil prices reduce, not just in Asia, but globally. But the effect in Asia, saw a dramatic reduction in margins again, such that margins came down. Now, that margin reduction has taken away from the peak, but has still brought them back to fairly good levels around 2019 levels, certainly for Group 2 and Group 3, because there's just such a significantly lower price of crude oil as compared to 2019 at the moment, running around $40 to $45 a barrel on Brent. So as you can see, it's been a very turbulent year to date so far. So what can we expect for the remainder of the year and then looking a bit further forward? Firstly, I'm going to describe to you a little bit about our methodology for assessing some of the effects of COVID-19 on base oils demand. So in terms of looking at short-term demand, as you've seen earlier, there's not a lot of raw data available in terms of the actual short-term demand, and even then it has a time lag. So, we're currently in September. The very latest data that's generally available is usually June, July, sometimes a little bit later, but on a whole, if that data is available at all. So to make a short-term demand forecast in terms of looking at what's going to happen in the remainder of the year, as we've been doing all year, and you may have seen in some of our earlier online presentations, we need to use some proxy measures. And so in terms of base oils, there's three factors that we're using at the moment. So in terms of the effect of the virus on the transportation sector and automotive, we're looking at the reduced fuel demand, so what we saw on some of those earlier charts, as a proxy for change-out volumes within the automotive section of the industry. So when people go in and have their oil changed or do their own oil changes, the reduction in fuels demand is somewhat of a proxy for mileage driven, and hence, those change-out volumes. Then we also gather a range of data, and we use some expertise from Oxford Economics in terms of the effect of the virus on various industries. So in terms of the industrial industry, so we're talking about things like end uses like metalworking fluids, process oils, heat transfer oils. Then we look at how the growth of, or shrinkage in the case of 2019, industrial sector is in various countries and regions around the world as a proxy for that industrial usage. And then if we look at the automaking industry, so the actual car making industry as opposed to the usage of cars and trucks, then when we look at that sector, then we get a proxy for the first fill component of demand within the automotive sector. So by those three proxies, we can estimate a base oil demand scenario going forward. So I'm just going to show. We have also considered throughout the year two demand scenarios in the coronavirus world. And so we had the short scenario, which was the most optimistic, and that assumed that the virus sped fairly quickly to most parts of the world, and that there would be short, sharp lockdowns, and that would last a few months, and then things would be relatively returned to normal by the year end, and there wouldn't really be a second wave. So that's one scenario that we had been considering throughout the year. As you can hear from the things I'm saying, we realize those things have not panned out. So the long scenario, which we were looking at, is more likely our base case, which assumes the worldwide spread followed by lockdowns causing considerable disruption. This disruption would last well through the northern summer, only to be gradually phased out. And then we would see a resurgence of cases in various parts of the world. And those resurgences would again result in lockdowns less severe than the first, resulting in more disruption. So we've effectively reduced or discarded the short-term case or the short case, and are running with the long case now as our base case scenario. But there still is obviously potential for that to get better or worse. Things like a vaccine would help reduce the impacts of the virus. But ongoing virus around the world will continue for that long scenario to drag out. So if I look at the industry implications that we have for each of these scenarios, you'll see here we track a wide range of industries, and this methodology is common not only to myself and the team forecasting base oils, but to all my colleagues in ICIS in the analytics department forecasting various petrochemicals, ethylene, propylene, etc. So we have a common view of what the underlying drivers of these demand are and the underlying effects on all of these industries. So you can see here the short term or the short scenario response. This region I've picked at the moment is Northeast Asia as an example, but we have it for all the regions of the world. In the short scenario, we would have seen that high effect early on in the first quarter, resulting in sort of negative or a reduction in the estimate compared to pre-COVID times, and then a quick recovery back to full 100% of what we thought pre-COVID by the third quarter. Whereas we see in the long scenario, which is more our base case scenario now, you start to see various waves of reduction in each of those industries, relatively affecting those industries more or less as COVID has an impact on each of them. If I highlight two key industries relevant to base oils, you can see the industrial sector, as I said, which looks at your industrial oil usage, and your motor vehicle industry, so your car production or your vehicle production. What you'll note there is that vehicle production has been one of the most affected industries across the globe. Not only in Northeast Asia, but in all regions, it's one of the worst affected industries. There's a number of reasons for that. One, it's related to end-use demand. So because the transportation sector is being restricted by lockdowns, people aren't driving their cars, hence they're also not looking to buy new cars. So that has reduced demand for the motor vehicle industry or the motor vehicle sector. But on the supply side, motor vehicles have a very complex supply chain. Lots of parts coming from lots of different suppliers. Each of those suppliers, as we're all aware, has been disrupted. Right? All our businesses have been disrupted. So that's disrupted that complex supply chain. So that's also making production side or the supply side difficult for the motor vehicle sector as well. So that's having a dual effect that's squeezing the industry. So that's why we see such a negative effect on the motor vehicle industry, or such a drastic effect on the motor vehicle industry. So how does this play out into the actual demand forecast that we have within 2020? So if I look at Group 1, we see a relatively muted reduction in demand and a fairly good recovery through the third quarter, and which we're seeing somewhat reflected in the prices already, and then a little bit of a stabilisation and perhaps another dip in the fourth quarter. And that's because Group 1 is heavily impacted by industrial output, which is predicted to predominantly return in 2020. It's obviously not going to return to 100%, but a lot of industry, particularly is essential industry. It's things that must run for economies to continue. So they are the sort of workforces that are prioritised to return and to be put back into the workforce efficiently. So hence we see a better recovery in that than automotive, which we'll see on the next slide. When I start to look at Group 2, we have a more mixed automotive and industrial applications that come from Group 2. And because we see that bigger drop in automotive, both from the motor vehicle sector and that first fill component and the demand sector from the changeouts, we see a bigger drop than we see in Group 1 because there's that bigger effect from automotive. So we see a deeper dive throughout the year, and then we see not quite as much recovery and probably staying at lower levels again in 2021 than we would expect from Group 2. And then finally, if we look at Group 3, it's the most heavily automotive focused, so hence it has the slowest recovery. So somewhat similar to Group 2, but even deeper. So this is where we're expecting demand levels in 2020. And as you can see, for what we've seen so far year to date, this is somewhat reflected in prices within the region. This is also affected by the trade position of each region. So, for example, Asian Group 2 is quite long, particularly Northeast Asia. So hence, even though there's a better recovery than Group 3, there might be slower price recovery because we see, it's a greater oversupplied market within the region. So if we put that all together and start to draw some conclusions about what this means, COVID-19 has made demand even more critical to setting the base oil price. Demand has been very important because the market has been very oversupplied with lots of capacity and relatively poor utilizations globally. So COVID-19 destroying that demand has made demand even more critical and the price even more sensitive. And as we saw on those charts earlier, you can really see that flow through of demand into price fairly quickly. We expect the demand to recover slowly through 2020 with industrial grades favoured over automotive and still to be a slow recovery through 2021. The margins for producers are going to be very susceptible to loss of demand or increase in crude prices, which, as we saw, don't really flow into base oils prices directly. So there's still a lot of potential volatility for producers and their margins coming through. And what we'll see is, as we see COVID-19 waves coming through in different parts of the world, recoveries coming at different rates, or if demand drops off quicker than or more than we expect for a second wave, we're going to see those changing trade flows like we saw in the first half of 2020, where really there's some quite dramatic changes in trade flows that are typically there, which obviously is a relative hindrance or advantage to producers in various regions. Okay, I'd like to say thank you to everyone who listened to this session today. I hope you found it useful and informative. If anyone would like to contact us in regards to this, then please feel free to get in touch via the networking app or during the question and answer sessions coming up in the next few days. Also look out for the presentation by my colleague Whitney in China, more specifically focused on the China market. And I'd like to say thank you very much to everyone for listening.